Hello there, my name's John Bone and I'll be your guide to non-current, i.e. long-term liabilities. In particular, in this reading, we'll be looking at how you account for bonds that you've issued. We'll also be looking at leases, both operating leases and finance leases, from a lessor perspective and a lessee perspective. And then we'll wrap it up with a little discussion on pension liabilities. Okay, let's get into our first learning outcome. So our first learning outcome asks us to determine the initial recognition and subsequent measure of bonds. Well, let's just do some definitions first so we feel comfortable. Par value. Now, the par value of a bond, of course, is the face value of the bond, and you receive that as an investor at the maturity date of the bond. Sometimes we'll refer to this as the redemption value. Now, typically, therefore, in the US markets, we're talking about a par value of $1,000. In markets like the UK, it tends to be £100. Now, coupon rate. Coupon rate, an alternative name for the coupon rate, is the stated rate. And of course, it's a percentage rate. And if you apply the coupon rate to the par value, you get the amount of the coupon. Now, the coupon rate is always quoted as an annual rate, even if the bond pays semi-annually. Our initial liability when we issue bonds. Now notice we've said the issue price, i.e. the proceeds that you receive when you issue the bond. And that is of course true for US GAAP, but you should be aware that it's not necessarily true of IFRS. The initial liability under IFRS is recorded at the issuance price minus any costs that you've incurred to issue the bond, such as brokerage fees, etc. Now, our effective interest rate is simply the discount rate, or the internal rate of return, that equates the present value of the future cash flows, i.e. our initial liability, or the present value of the future cash flows, with our issue price. And remember, our issue price will be the initial liability. So in other words, the effective interest rate is simply the yield on the bond when it's first issued. Again, that's true of US GAAP. Under IFRS, because the present value of the cash flows is reduced by any issuance costs, you have a lower liability, and that means you're going to get a slightly higher effective interest rate. Now, the interest expense, and this is what's going to appear in our profit and loss account. It's going to appear in our income statement. It's going to be the opening book value of the liability, so the liability at the beginning of each year times the effective interest rate. Now again, let's be very clear here. Notice therefore that the interest expense is not likely to be the same as the coupon on the bond. Okay, and what we need to do is work out the liability values each period, the interest expense and the amortization. Okay, now let's have a look at this. We've got an opening liability there of 951.96. Now, if we take the market interest rate when the bond is issued, 12%, and we do 12% of the opening liability, so 0.12 times 951.96, we get 114.24 with a tiny bit of rounding. Now, of course, that is the interest expense, and that's what's going to appear in our income statement. Compare that to the coupon. The coupon is 10% of par value, $100. Now, the difference between the interest expense and the coupon must be the discount amortization. So 14.24 must represent amortization. Now, that 14.24 increases the interest expense. That's why the interest expense is 114.24 and not $100. The other side of the double entry is it's going to increase the liability. So the liability at the end of year 1, beginning of year 2, is now 966.20. Now, to get the effective interest, or the interest expense in year 2, take our effective interest rate of 12%, multiply by the opening liability at the beginning of year 2, 966.20, and we've got 115.94. Now, notice the difference with the coupon paid. This time we've got 15.94. And of course, that's going to increase the liability value at the end of year 2, beginning of year 3. So our liability value is now 982.14. Year 3, let's take our effective interest rate of 12%. So 12% of 982.14 gives us 117.86. The difference between the interest expense and the coupon is the amortized discount, 17.86. That increases the liability from 982.14 up by 17.86. So at maturity at the end of year 3, our bond is now sitting there at $1,000. And of course, then the bond is redeemed, $1,000 is paid out, the liability is extinguished, and there's no gain or loss through the income statement because proceeds equaled liability value. Now, I did say, you could enter this or do this all on the calculator, and it will give you these years. So let's actually have a little look at doing that essentially together. Let me just blank out some information here. Hang on a second. Okay, let's just erase some of our data temporarily. Okay, and let's talk about our button presses. First of all, you just need to enter the data about the bond. So we've got a 3-year. So N on our calculator equals 3. Sorry, I just thicken the ink up on that, make it a bit clearer. 3-year bond. Future value, it's of course $1,000. It's got an annual coupon of 10%, so payment equals 100. Present value is the proceeds received, 951.96. And we can type in IY as well. Either you can compute IY or you could type it in. We've been told that that is 12. Okay, let's just thicken up that first one. N equals 3. Okay, so enter that on your calculator on the time value.